Well, hello, everyone, and welcome to Wealthologist Live. I am Chris Hobart, the Wealthologist, and I am thrilled to be here with you. This is our monthly opportunity to share some critical financial insights about what's going on in the world right now, kind of help you navigate today's markets and also build towards a stronger future. And as always, I'm excited to be joined by our brilliant lead investment strategist, Jacob Woodrum.
Hello. It's good to be here.
Well, that's good to hear that. Welcome back, Jacob.
Thank you.
Last time we were on,
Yep.
you and I did a crazy beast.
We did a beast race, but you did something here recently, right?
I did.
Yeah.
I actually have a slide of this because this is a proud moment for me. A lot of folks don't know, but a few years ago, old Chris struggled with making good decisions about eating and working out. And I've really tried to change over the past couple of years. Some of you know that I've done some endurance climbs, which have been really exciting. But one of my passions now was to actually go and do 3 trail marathons in 3 days.
Well, and I'll tell you guys, I mean, him and I did a beast race, which was about 15 miles, 14 and a half, 15 miles. And this guy was doing, a marathon every day for 3 straight days.
Yeah, it was
It's
officially,
impressive.
it was like 82 and a half miles over 3 days with 15,000 feet of elevation gain.
Yeah.
There are certain things that test a man. I will say that
I can't imagine
that will test man. What's interesting too is on both these events, and then we're going to get into this. But on both these events, I'm allergic to yellow jackets and wasps, and my biggest fear is always getting stung. I've taken allergy shots, but I always have my EpiPen with me. And on both of these events, I got stung, and I was really worried it was going to take me out. And fortunately, on both of them, I was able to Benadryl through it and not have to EpiPen, which allowed me to finish.
Yeah,
but anyhow, pretty exciting stuff. Let's see. Let's take us off of here and go to regular screen. So as always, Jacob, we're going to kick off the day with what we call our 3-2-1 segment. And this is where Jacob is going to highlight 3 important economic updates, talk about 2 managed portfolios that are showing strong results right now or have purpose in our planning. And then we're going to talk about 1 valuable financial tip that we can give as well. So as always, you've got important insights. This is what you spend your days here doing is kind of parsing through information, building and managing the portfolios.
Right.
So as we head towards the end of the year, and as we look at this little thing called an election coming up and all the different things, I think that's going to flavor a little bit what we're talking about. Maybe not too much because people are tired of hearing about the election, to be honest.
We've talked a lot about the election.
Just a couple more days, folks, a couple more days. But Jacob, hey, my friend, take it away. Tell us a little bit about what your top 3 economic concerns are. Now, again, 90 seconds.
Yeah.
I'm not going to be too sticky here, or too rough here, but let's keep it pretty tight.
Sounds good. So what I really want to make sure that we're covering today in the 3 topics that Chris just mentioned, we're going to talk about interest rates. Let's talk about jobs a little bit. And let's also talk about kind of what we're expecting out of the economy as we move forward. And, I want to start with, and I know you guys are probably sick and tired of us talking about these topics because we talk about it a lot. And specifically interest rates, and you may be asking the question, why interest rates? I know we talk about it all the time, and we're always dialed in as to, what the Fed is doing and what Fed Chair Jerome Powell is doing. Well, interest rates are so important because at the end of the day, they really do dictate what the value of our assets do. So stock market, real estate, bonds, things like that. And, the way I always like to think about it, and I know we've talked about this before, but, I call interest rates kind of the financial gravity of assets. And so if you think about gravity in the normal situation, well, gravity, when it goes up, it pushes pushes objects down and vice versa. If gravity is going down, it's going to push things up. And so if you think about that in terms of finances, if interest rates are going up, that usually puts downward pressure on the price of assets and vice versa. And so that's why it's, it is so important, interest rates. And so I wanted to mention that first, and I'm probably halfway through my.
Well, I mean, you just spent all 90 seconds telling people. Now, real quick, I do want to say something because people are like, you do talk about interest rates all the time, guys, and some of you are sitting there saying, Chris, Jacob, last time you talked, I believe Chris made a bet that they weren't going to increase interest rates prior to an election. I owe you money, Jacob.
Well,
I don't remember how much we bet though.
We're okay.
All right. I was expecting to make
we'll
up
do
a big number.
Bet next time.
It was $1,000, I'm sure. No. All right. So go ahead. Let's jump in on this.
So when we think about, I just want to pinpoint a couple things. So, last month we had the Fed cutting interest rates by 0.5%. And that was pretty important because we were all kind of expecting 0.25%. That's usually what, the Fed cuts when they do a cut, or at least
now, real quick, I want to just throw something of interest in here. A lot of times when we're hearing the news, they don't say 0.5%. They use what are called basis points.
Yeah.
So when you hear 0.5% or you hear 50 basis points, that is the same thing. When you hear 25 basis points or 0.25%, it is the same thing. So that goes to say that 100 basis points equals 1%. So just so people know, you didn't say anything about basis points, but I think you hear that on the news sometimes. And I remember before I got in the financial world, I was like, what the heck is a basis point?
That's us. That's us making things confusing at the end of the day.
It's the financial world trying to say, how do we look mystical and magical?
So anyways, that's a good point. But when we think about future cuts, because that's what's really important, I think Powell, which is the Fed chair, he really pointed to the fact that, more cautious about cuts as we move forward. We are anticipating more interest rate cuts as we move into this year or into next year and even into 2026. And we could potentially see, about a 3%, interest rate, or getting interest rates closer to about 3% in 2026. But again,
no bets.
We'll see where that
I refuse to bet on interest rates anymore. Years ago I bet Corey, this is when times are really, really, really rough in the U.S. With the economy, that we were going to potentially jump into negative interest rates.
Yeah.
So I am always negative Nelly when it comes to interest rates. Hey,
It's
That's all
okay.
right. And,
We balance each other out.
Exactly. There you go.
All right. So the second point that I want to talk around is just the job market. So labor market concerns, and really the focus on the job market. It's important because interest rates are one thing, jobs are another, but they do go hand in hand. And so the Fed's decision to cut rates 0.5% last time was really a shift in their focus from kind of this concern on inflation to a concern about the job market. And that's important, but the unemployment concern, I think, is that, and Powell highlighted this, last month, was that he sees probably a rise in unemployment to about 4.4% by, end of the year, which, just to put that in perspective, right now we're about 4.1%. Now, that sounds dangerous and sounds a little bit scary at the end of the day, but despite really where we're at with unemployment, the job market and the economy are still strong. And I think the last thing I'll say about this is just from a data standpoint, when we see the rise in unemployment, I think it's a lot more to do with the fact that less about jobs, losing jobs and seeing a lot of layoffs, and more that we've got more people looking for jobs. And so that's, those numbers and statistics that you have to be careful with, because it's easy to look at something and then say, oh my gosh, something's wrong. But it's important to kind of, peel the onion back and look further into the data.
Yeah, and I think we're definitely seeing a difference in that as well as we look to continue to grow. One thing I'm interested in, we don't have to really dig into it, but both administrations right now are talking about tax-free income for tips for workers. Now, if you're like me, you're already sick and tired of tipflation. But I was going to ask you a question. Would you mind if your paycheck, instead of a paycheck, was a tip? that every 2 weeks, the company gave you a tip, which is tax-free to you.
Hey. How big of a tip are we talking?
Hey, there you go. It won't be in cash, so it'll still be direct deposit.
Chris and I will take this discussion offline once we finish.
I do wonder how that's going to change, though, the employment world, because I do think you're going to find a lot more people seeking out those jobs that are a bit more tip-focused, because if you can have income.
Right.
Look, I used to be a waiter, and when I was a waiter at Pizza Hut when I was 16, 17 years old, I sound like a politician right now. We won't go there. But when I was a waiter, if you could get tax-free tips, in fact, funny story here, at one point, I didn't realize when you got a cash tip, you were supposed to enter it into the system.
Oh, yeah.
So I wasn't entering it into the system, and the manager came up to me one day, and she's like, Chris, are you getting no tips? And I was like, oh, no, I am. And she's like, you got to put them in. You got to pay taxes. It's really my first experience with the tax man. So, all right, go ahead. Number 3.
Good times. Yep. Last thing that I'll talk about on this portion of our time here is just a kind of a future economic expectations. And you guys will have to kind of hang with me on this, but I wanted to talk about sort of the Fed's a strategic shift I think we're seeing with the Fed, and specifically this thing called the Beige Book. And this is a report that the Fed basically creates and pulls that it reports on growth essentially. And so what it's showing, though, and what it showed last report, was that we only had 3 districts that really reported growth. And I think that's important because the month before that we had about 7 districts reporting growth. And so we're starting to see just a little bit of and it's not a surprise. We've been talking about this for quite some time, is that we probably do see growth slowing, as we continue to move forward, especially into this coming year. But again, that data is so dependent on the moving parts and pieces and where consumer spending is, and GDP plays into it. So it's something that we're watching, we're looking at, we're paying attention to. But I think that was the main reason why we saw the Fed move, from a 1/4 point cut to basically a 0.5%.
I'll be honest with you. The whole time you were talking, and I know somebody out there is like me, I was wondering who named it the Beige Book.
Well, it's a great
question. If somebody can Google that for me real quick and shoot me an email, I would appreciate it, because I'm going to be doing that as well. Just seems like a pretty base name. Anyhow. Jacob, I do appreciate, we do talk about the rates and everything, and we do know that those rate cuts are crucial. And it's a good reminder that we do have to keep a pulse on what the Fed is doing. We've got to understand, it helps us understand that broader market and how it impacts employment numbers and from a business perspective, loans, the housing market, all of this begins to wrap together, and it talks about the health of the economy. So with that said, our next part of the 3-2-1 is to highlight 2 portfolios that you find kind of most compelling to talk about. I think you have a slide here.
Yeah, I've got a few slides. The first one that I want to highlight is an income growth plus portfolio that we manage and that we run. And, to kind of start high level with this, I think mentioning a few things that are important. So this is a portfolio that is a combination of stocks and bonds. So, it's not just all stock, it's not just all bonds, but it's really a blend of the two. But it has a focus on income. And so within the portfolio itself, with the stock and bond allocations that we have, we're yielding in that portfolio just shy of 4%. So right about 3.77% yield. And the thing that I'll just highlight with that is we're beating our benchmark yield that's right in about 2.7%. So we're really looking to try to drive return with income, from this particular portfolio.
And I think what's important here, sometimes people are thinking yield and they know that CDs or bonds are yielding maybe a little bit higher than that.
Right.
And I think the difference is when we talk about yield in this portfolio, we're talking about yield being bond driven as well as distributions from a dividend paying stock, which means that we're also getting the growth of the stock paired in there as well. So this is just what it kicks off. Think of it like a rental property, right? So the rental property has its own value that goes up and down, and it has a renter that pays that income. So the yield is just the income coming off the portfolio. But the nice thing is you're getting different types of growth from this, which is stock growth as well as distribution growth.
Yeah, and that's a good point, because right now when we look at this type of a portfolio, we've talked a lot about how growth has really driven the market this year, especially those Mag 7 companies that your Googles and Apples and Amazons and those companies that are really great companies, but they're pretty expensive because they've been doing so well. They're just sitting at a high levels of value. And so when we look at where values are for a portfolio like this, they're much more attractive relative to some of those high-flying growth companies, which I think speaks to the slide that we have up here, which is just a comparison of basically a side-by-side showing the S&P downside. Whenever we look at a portfolio, we're always looking to stress test. And so we provide a stress test summary whenever we're looking to make a decision on changing allocations or recommending a portfolio for someone. And I think what I like about this right here on this slide, and we won't go into each of these different scenarios, but just the high level, if we look at what the downside is on the S&P, you're looking at a 40% downside based on all these different stress tests we've run through our software. Whereas our income growth plus portfolio, it's got downside at the end of the day, but a lot less than the S&P.
I mean, you cut it in half,
and still good, upside potential.
Yeah, no, I think that's that's a nice portfolio. I mean, the reality is when we have such overweighting growth from 5 to 7 stocks, it's tough to compete with that without taking that level of risk. But if we can cut the risk in half and still get reasonable returns through growth and distribution, I mean, that's a great story, specifically for people that aren't in the market to get hammered the next time it drops.
And I think we have maybe one more slide. This is just a continuation of that first page that I was showing, which again is just showing different scenarios that we can look at, and we can say, okay, well, if we were to run into geopolitical concerns, or if we just think we're going to get kind of baseline, standard, straightforward markets over the next couple of years, how does that look from our portfolio's perspective, or for a portfolio we're considering going into? So tools that we can use, and we can even kind of customize for folks as well.
Yeah, and I will say I love that tool, the stress testing tool. Every once in a while, our clients come up with some just different concepts that they're worried about, and we understand it. And sometimes it's hard to talk through that, but this tool allows us to take a look at warfare, tax law changes, another like a pandemic scenario, you name it. It kind of builds in different scenarios. Obviously, it can't be perfect, but it does allow a stress test and to have conversations around what we need to be doing in different scenarios.
Yeah, I think it's really helpful. All right, so let's go to the next one. The next portfolio is, and we've talked a little bit about this before as well, but it's what we call our dynamic tax efficient portfolio. And what I like about this is, we're really looking to track an index. So typically, we'll track like the S&P 500 or one of the Russell stock indices, and we're looking to hold individual stocks in this strategy. But the key with this is that we're not only going to try to track the index, but we're also going to look to harvest losses when the opportunities present themselves. And this slide just shows us the benefits of, so for example, a 2023 scenario where if we started with $1 million of cash, you can see that we were up in 2023 about the same as the index, 26%, but we were also able to harvest about, in this example, about 11% of losses as well that then we can use to offset in other ways. So it really just gives us a very customized approach. We can also invest if we need to based on, focusing on values, or if we want to have a specific, I say tilt, but just a specific concentration on, types of investments to invest particularly in, or if we want to say we don't want to invest in something as well.
No, and correct me if I'm wrong, but that can be anywhere from, wanting to invest more in vice type stocks, smoking, drinking,
right,
that type, or wanting to go more towards religious-based
yes,
stocks where you're saying, look, I want to avoid certain companies that might not fit that. I mean, there's a lot of ways that we can do that. What I like about this is I really enjoy individual stocks, not for entire portfolios, right, but in this case, I really like to see those individual portfolios. And I cannot stress enough how impactful that tax loss harvesting is for non-retirement account portfolios. Inside your retirement accounts, your IRAs, 401k type accounts, it doesn't matter. Yeah. But inside of this, all you're doing is you're taking advantage of anything that's not doing the best in the portfolio, offsetting some gains, so you can be building a stronger and stronger and stronger portfolio with better tax advantages long-term for yourself or for your loved ones. Really, really smart way to do that. In fact, we're moving a lot of clients towards this type of a model, and we can do it staggered, over several years to get it in place, so we're not creating a big tax hit in order to do that.
Right. Yeah, that's a great point. And I think the way I see a lot of good, I guess you'd say, use cases for something like this too, is if someone has a highly appreciated asset and they have that, held in a separate account or even with us, but then you've got, a portfolio that we say, well, we want to be able to really focus on creating losses to try to offset, if we're trying to diversify away from something like that. It could be even a business that someone holds. So if you're going to be selling your business in 3 to 5 years, we have the ability to use a strategy like this to create a, kind of a quote unquote tax asset to build up. And so there's a lot of different ways I think it can make sense for folks.
And I think this is a case where if you've got questions about this, you're a little bit interested, reach out to Jacob or reach out to one of the CFP advisors here at the firm. We can all talk around this or to this, but Jacob is the expert that can actually build a specific portfolio for you. And I will tell you, when you showed me some of the stuff that we're able to build now and illustrate for the tax benefits, and then when we put that in front of clients and clients kind of sit there and they say, I like this structure for this reason, it's just like perfect.
Right.
And we can always pivot and adjust because taxes are going to change. I mean, we know next year, sunset provision of the tax code potentially. So, I think what I like about this is both of these portfolios are examples of well-managed strategies that can align for different goals, some growth in income as well as tax planning. So depending on what you're wanting to do, obviously the markets are always evolving and we've got to evolve with our portfolios. And that's your job. That's our team's job. So if you've got questions about this, let us know. We're more than happy to talk with you about that. Now, Jacob, last thing I've got you to do today is really Jacob's financial planning tip or something towards that can be impactful for folks.
Yeah, and I think the one thing that I have for today, and I'm going to kind of keep this short because I know we probably need to keep rolling on, and it's a little bit less financial planning, but it is in some way. And I heard this the other day, and it's funny. I was telling the team, I have to sometimes be reminded of this from an investment standpoint. So I know if I have to be reminded of it, probably others can benefit from this as well. But when we think about investing, and especially when we're thinking about investing in the stock market, it's so important to remember that we're actually, buying minority ownership, in shares of companies. We're buying ownership in companies. And I think that is really important because for us, it's easy to look at a ticker on a screen and a price and just kind of forget that we're actually owning, a piece of a company. And remembering that we're owning a piece of a company really, I think, just helps us to sort of sometimes hit the reset button, especially when times are difficult. If we're seeing markets being down and, our accounts are down in value, saying, oh, I actually own shares in a company, and it's probably not in my best interest to just sit there and say, oh, I got to sell because the market's down. No, I invest in a company, it makes money. Just because the market says it's down in price doesn't necessarily mean that the value of that company has dropped by 10% in a week or whatever the case would be.
It's funny. I literally was driving Blythe to school. She just turned 12 last week. By the way, folks, Sloan, my oldest daughter, just turned 18. Wow. I know, right? But Blythe and I were driving to school, and we were talking, and she loves her makeup. 12-year-olds these days, they love makeup, like in a weird, crazy way, I'm telling you. With that said, I said, well, maybe we should buy some Ulta stock for you for your birthday. And first he was like, no, I don't want that. I want makeup. And I explained to her, I said, yeah, you're owning the company. She's like, well, how do I get to own Ulta? And I said, well, it's not like you own the store, but you own a piece of the store. And I had that same conversation. And I asked her, I said, do you believe in what Ulta's doing? And do you like what they're doing for you and for your friends and all the people you see in there? And she's like, everyone wants to buy makeup, Dad. Right. And I was like, well, wouldn't it be great if you own the company? They pay you to buy makeup. Right. So she kind of got it. I may have made it a little bit rosier in that regard for her. But that's solid advice.
I love that perspective. Company too.
Yeah, so well, there you go. But not a recommendation for anybody out there. I think compliance wants us to say that anytime we talk about a specific stock. So, so thank you for the 3, 2, 1. Now we're going to move on to one of my favorite parts, which is, Hey Hobart. I think I've got the graphic going. There we go. Look at that. I got a new graphic for everybody.
Chris told me to punch him if he forgot to do the graphics. So
people work very hard on graphics. So I want to give them credit. So, but this is where we answer credits from different viewers. We provide guidance on real world financial planning. And today we had a question from Cheryl in Greenville, South Carolina. And she wrote in, she said, hey Hobart, I'm 57. My husband and I are aiming to retire within the next 5 to 7 years. With interest rates high still, should we focus on paying off our mortgage, or would it be smarter to invest in those funds instead?
Yeah, great question.
Yeah, right. I mean, Cheryl, you ask a very smart question, specifically where you are nearing retirement. And we hear it from a lot of folks getting closer to retirement. And I really want you to think about 3 key things. First, interest rates versus investment returns. If your mortgage interest rate is relatively low, let's say under 4%, so you've got one of those older mortgages, it might make more sense to invest instead. In other words, you can get better returns ideally in the market than 4%. So you get that difference of what you're paying for the debt and what you're earning on that same money. Historically, when we're talking about diversified investments, they're going to yield those higher returns. So low interest rate on your mortgage, maybe keep the money invested. Something else to consider is flexibility in cash flow. The thing we tell everybody is retirement's all about keeping your options open. So if you're paying down a mortgage and it leaves you stretched thin to have extra assets, balance is the key. So don't overcommit to paying off your debt at the expense of having liquid cash for day-to-day needs or opportunities that may come up. Again, I think flexibility is the key there. And then finally, there's what we'd call a combination approach. And, a lot of our clients find that putting some extra funds towards the mortgage while also investing them, it gives them the security of reducing the debt and also giving the growth of the investment portfolio. In other words, it doesn't have to be all in or all out. Yeah. Sometimes it can be healthy. A healthy combination of those. I look at that like dieting, right? We talked early about Chris hasn't always made the best eating decisions. It's because a lot of times I'm all in or all out. Turns out that if you eat a balanced diet, it's better for you. If only I knew that the past 20 years. So anyhow, Cheryl, thank you for reaching out. And remember, everybody out there, you can submit your questions for the next Wealthologist Live by emailing us at heyhobart@hobartwealth.com. Now we're going to do something a little bit different for Wealthologist Live. It's a segment that we're calling Quickfire Q&A. So here's how it works. Jacob, you're going to ask a couple of rapid-fire questions that have come in that are easier to give short answers to from our audience. And I'm going to give quick answers to keep it flowing and accessible. So you ready?
Let's do it.
All right. We're pulling up the first question. Go ahead.
All
my
right.
friend.
First question. So should I consider investing or should I consider a Roth IRA conversion essentially?
Well, and here's the thing. Yeah, for a lot of folks, not everybody, but Roth conversions, they can make a lot of sense, especially if you think you might be in a higher tax bracket in retirement, or if you think tax rates are going to be going up. Converting now, though, it does mean that you're paying taxes at today's rates, but you're going to be enjoying tax-free withdrawals later.
Great.
So, but again, one size does not fit all on that, and there's a lot of strategy behind that. Can impact your Social Security and all of that. So talk to us if you want more details on that.
Excellent. All right. Second question is, what's the best way to invest my year-end bonus?
Well, I mean, that's a great question. First thing that comes to mind is if you have high interest debt. Cheryl asked that question about interest rates, but if you got high interest debt, then paying that off or paying that down is a good first step. But then directing the money into, retirement accounts. Again, we talked about Roth IRA. If you don't have an emergency fund, right now, emergency funds, because of interest rates, are still relatively high. They're paying well. Yeah. And then also consider, putting the rest into some form of a diversified portfolio.
Yeah. Yeah. Excellent. So the last question, I think this is the last one we've got. Are there any benefits, or what are the benefits to donating essentially highly appreciated stock?
The biggest thing is you avoid capital gains taxes. So if you've got something highly appreciated and you sell it, you're going to owe tax on it. If you give it away to somebody, you get a tax deduction based upon the stock's fair market value, and you're not going to incur that taxable gain. So if you've got that and you are giving money away, it is a strategy. There are a lot of strategies, though, for giving money to charities, specifically for people that are required minimum distribution age. So there you go.
Well, and the other thing too to remember is, if you do have that highly appreciated position and you want to use a direct indexing strategy or a custom indexing, you could do that as well.
Good plug. Good plug.
Yeah. Well, thank you guys for those fantastic questions. Keep sending them in. We'll keep bringing you the answers.
Yep. And again, you can send those to heyhobart@hobartwealth.com. So as we wrap up, I want to thank everyone for joining us today. Jacob, thanks for putting the time and the work into that. I get to be color commentary. You get to give all the important information.
That's great.
I want everybody to remember, though, as we do this Wealthologist Live, it is here to give you the tools and knowledge to really make good and smart financial choices and decisions. Next month, we're going to be talking about year-end tax strategies, and we're also going to look ahead to potential economic shifts in 2025. And there's a chance, not guaranteed anyone, but there's a chance that we may know who the president is next month for our weekly or for our Wealthologist Live. I think it's going to be November 20th. Yeah. So there's a chance we'll know who the president is.
Let's hope so.
Maybe. If you enjoyed today's session, do us a favor. Like, subscribe, and share this with a friend who could benefit from our insights. And you can always find more content on our YouTube channel. We're always here to answer your questions, so reach out to us as well. Thanks again for being part of Wealthologist Live today. And until next time, take care, stay informed, and keep moving towards those big financial goals. We're always happy to help you in those processes. I'm Chris Hobart, and this is Jacob Woodrum, and we'll see you next month for the next Wealthologist Live.